Hey Doug, thanks so much for your question. The problem is that property really isn't an income style asset. In fact, it's quite lazy from an income perspective. I mean, if you think about all the expenses associated with holding property, land tax, property management, insurance, insurance has risen a lot. All properties require some level of maintenance, maybe not every single year, but over a period of time. And all these and council rates, I mean, that's a big one as well. They've risen a lot over recent times. So they all eats into your property income or your investment income. So in order to get $150,000 net of expenses from property, we really need to assume you've got maybe a 2% net rental yield, which means that your gross yield might be 3.5%. But after you subtract expenses, you're only getting 2%. In that case, you need $1.7 million of property in order to generate $150,000 of income. Well, how can you do that? Well, if you go out tomorrow and buy a property for, say, $2.8 million, and it enjoys a 7% compounding capital growth rate over the next 15 years, and you're able to repay all the debt, you'll probably get there. But it's a pretty lazy strategy, and you've got to find yourself $2.8 million of spare cash flow to repay that debt over the next 15 years. Probably unlikely for most people. So how could you do it? Well, I was thinking about it. There's a commercial investment that I have just helped some of my clients make that is a portfolio of 15 commercial premises leased to federal or state government tenants with about 99% occupancy and obviously a very long track record of paying a high income. A lot of the income being tax-free as well, more than 50%. And that investment is yielding currently 7.8%, although they project or hope that they can get that yield higher. So if you had $2 million to put into that fund, for example, that will get you there in terms of $150,000 of income. So how can you get $2 million over the next 15 years? Well, I worked out if you buy a property for $1.6 million and you hold it for the next 15 years, and if the average capital growth rate over that 15-year period is, say, 7%, which is, on the higher side, it needs to be a great quality asset, but still doable, that in 15 years' time, that property is going to be worth $4.1 million. If you then go and sell it, you repay the loan, say 1.7, including costs and so forth, less $660,000 for capital gains tax gives you $2 million. You could then take that $2 million, put it into that commercial property fund that I just mentioned, and you would generate $150,000 of passive income. Now, the problem is, would you do that? I mean, it's quite single point sensitive, of course. You're relying upon one property to deliver all the returns over the next 15 years. And then you're going to take that money and put it all in one basket in terms of that commercial property fund. Doesn't make a lot of sense. It's very single point sensitive, as I said, on those two different investment assets. But I just thought conceptually that's the way I would start thinking about it. It's really use property. I talk about property or investment assets as like, golf clubs in a golf bag. You've got to choose the right club for the right shot. Property is a high growth asset. Its job is to build your net worth, your asset base. Its job is not to increase your passive income. So play that shot first, invest in property to increase your net worth. Once you've done that, then you need to choose a different club like a putter. You want mostly income from the investment because you don't need as much capital growth because you've already built your asset base. Anyway, there's my answer. It's not a perfect one, but hopefully it alludes to some things you need to think about from an investment perspective. But thanks, Doug. Thanks for the question. Cheers.